welcome to the Columbus Multifamily Investors Meetup. My name is Matt Engel, and I am the host this evening. With me is Tre Giller, multifamily investor and developer, and we are super excited to have him with us tonight. A couple housekeeping items. Restrooms are in the back there, and if you haven't yet already, go ahead and sign in at the QR code at the front table. And with that, I will turn it over to you, Tre.
Okay.
Tell us a little bit about yourself.
Sure. My name is Tre Giller. I'm President and CEO of Metro Development, which is a vertically integrated development company in Central Ohio. I've been with Metro, or one of their subsidiaries, for the last 26 years. My responsibility is to run the 6 different organizations we have under the Metro umbrella, which ranges anywhere from the Metro Development, from construction, purchasing, property management, and then some of our ancillary businesses, our commercial real estate brokerage, as well as some different utility companies that we own that are subsidiary organizations to our multifamily projects. We also do quite a bit of single-family lot development in southern Delaware County. We've done that probably 300 to 500 lots on a year in single-family development in Delaware County. And currently we've got between 55 and 5,600 units in the pipeline from a multifamily perspective, from anywhere from in the original zoning stages, or the beginning zoning stages, the bidding stage, construction stage, or completion stage here in Central Ohio.
Awesome. Well, this is one thing I ask all our guests right off the bat. What's your why? Why do you do what you do? What drives you?
Well, I think at the end of the day, I always like to think of myself as in our business, it seems there's two ways to look at it, right? You're either a farmer or you're a hunter, right? You're either farming, which means you're doing property management, or you're managing an asset, doing something of that nature. Or you're hunting, which means you're out trying to find deals, find opportunities, and then work through that process. I find myself to be more on the hunter side. I enjoy the thrill of the chase, to go through, find a project, find 5 acres, 10 acres, take that through from a R zoning all the way through an AR zoning in the city of Columbus, or a PUD in the outer areas, and then see that become from a 5-acre or 10-acre piece of vacant ground to a 240, 280 unit multifamily complex that we either decide to keep or sell. And that's what I really enjoy. And it's just my personality that sees it that way. I have to do the farming as well, unfortunately, when you have 800 employees, but yeah. I like the hunting much better. And I think that's the why I do it is I enjoy it. There's, good example today. My day started talking about cost controls in our business, and then we moved on to changing our operations from a construction phasing perspective, then to talking to a Delaware County commissioner about a project, then over to a Fairfield County commissioner, then back talking about insurance, then meeting with a bank this evening on a construction loan that we're doing, and then coming here. So my day's full of all kinds of different things, which makes it much more interesting than just sitting at a desk doing one thing.
Gotcha. Yeah, I'm the same way. I love changing things up a little bit. All right, do we have any questions from the audience?
I do. So you mentioned like 500 single-family developments in southern Delaware County. So is that where you're like taking just like raw land and getting it ready for a single-family residence to be built?
Yeah, we've done we'll do that. We've done quite a bit of. We've done some major sewer work for Delaware County, which opened up some different territories and different acres. So if you're familiar with Delaware County, kind of in a box, I would say it's Sawmill Parkway, from Hyatt's Road to Clarkshaw, from Sawmill Parkway, and then going to the west over to the south section line. So that's the development we're doing now. We also developed Cider Reserve Golf Club and Kinsale Golf and Fitness Club in all of Kinsale Village area over the years. So done developments, large scale kind of developments of that nature. Right now we're spending more of our time driving utilities, zoning the projects, and then selling those blanks off to individual home builders for them to then come in, construct the homes. We were in the home building business for a while. 2006 came along. You figured out real quick having 1,000 lots or half-built homes when the banks didn't want that. That was not a good thing to have on your books. So we decided in 2010 to really jump back into the multifamily where we're more comfortable and really do the multifamily construction really from 2010 to today. We've done quite a bit in Central Ohio, Franklin County, and the surrounding counties.
Yeah.
You said you've been doing this for about 25 years or so. Have you seen anything in the change in urban development with working with the cities and getting zoning over that period?
Well, there's a lot of things that, when you say change, right, you're saying the question is good or bad, right? I mean, it's a good change, right, or bad change, or, it's change. And there's a lot of change. I mean, I can't say that it's always good or always bad. People are talking more today about multifamily and the need for workforce housing, right? If you listen to any politician, they're going to stand up there and bang their hand and say, we need more, right? That's all well and good when you're standing up there saying we need more. However, when you really work through the process, the people that make those decisions are really the bureaucrats behind the scenes, right? They haven't changed, right? The politicians currently have changed where they're looking for more of those opportunities. But when you get into making the sausage, the guy who was there 20 years on the city traffic department, he's the same guy. Well, he hadn't changed, right? He was difficult then, he's difficult today. It really hadn't got better. It's just the politicians are speaking more of the need for housing, and I think that's a change that you're hearing. I think it's it's interesting because it's really. It's kind of a pendulum that flows back and forth, right? And with real estate, in my business, it's usually, especially on the lending side, it's usually really one extreme or the other extreme, right? And that's kind of, from that perspective of the lending side of it, that really changes back and forth really radically. But the zoning process, the understanding the utility process, my business is much about understanding where the utilities are and how to get the utilities, because you cannot develop an apartment complex on well and septic. It just doesn't work, right? It doesn't work. So those kind of things, my business as much as understanding how to get through those processes and bring those utilities at a reasonable price to the site in order to then service that site that started potentially as 5 acres of farmland with no utilities. Well, the value of 5 acres of farmland with no utilities is, $30,000 an acre. You find a way to get utilities there, all of a sudden it's worth $200,000 an acre. And so that's kind of what it is. From a change perspective, the rhetoric has changed, but the process is still the process, which is what makes it very difficult for people to get into the real estate development business, because you've got to have that time on task to figure out what the process is. And every municipality is different from a process perspective.
You were talking about that earlier with me, about the expansion out near Intel and whatnot. So then, where does that start? Is it tax dollars that have to be approved to get the main lines in that can then branch off? Or what's that process?
Yeah, so if you're looking at, Intel's a great example, right? What's driving the development to past New Albany, really up into that Johnstown area, is the fact that Intel's dropping, a multi-billion-dollar, revenue source in the middle of a farm field. So that drives the process to get sewer and water and roads. That's a state-driven process from ODOT on 161. It's a City of Columbus process to get the water, because they need so much water, and services in order to be able to develop that. Well, they're specifically bringing it for Intel. Fine, that's zoned and ready to go. A developer like myself who wants to do multifamily has to go through the Johnstown zoning process or whatever municipalities around zoning process to get the project approved, then figure out how to get the sewer there, because they're not driving the sewer there for a vacant 500-acre piece of ground with no plan or density or anything on it. So that's kind of where the rubber meets the road, is it's what comes first. You know, a developer like myself will say, put the infrastructure in, we'll come and build. The city says, you put the infrastructure in, then we'll bring the infrastructure after you put it in, or, you know, and then other people can build. Well, so who's going to take the first step on that particular situation? So it gets a little more complicated when you start thinking, yes, Intel's very important. Everything over there is going to be very important from a revenue standpoint, an economic standpoint. However, housing is going to be equally as important. And as we've read in the papers, and we know because of the problem that we're in the business, they don't want housing. They want Intel. Well, you get Intel, you're also going to have to house people where you're going to have these people live at a reasonable price point.
Any other questions?
Just one last thing on this topic. So, how does that work then with the sewage? Like, is that flowing all the way to existing, what do you call them, purification plants and whatnot? It's like, is that already going in, or like they have to build new, I don't know these terms. It's like
Yeah, it's a
stations, you know?
Yeah, it's a combination of both, right? They're running a huge deep trunk sewer all the way out there. They already have one. If you think about it, not every municipality has their own sewer system.
Right.
Columbus is sewer for New Albany, right? So that's the deal they have. And I mean, they go around the city, that Columbus is sewer. So from that perspective, Columbus has to run sewer out and have to treat it backwards. So if it's a gravity system, which they like to run a gravity system versus a force main system, they're running a deep trunk all the way out there, right? And that's for Intel. Now it'll be available for other things once the zoning happens, but originally it's for Intel. And they're doing upgrades to their system because they have to, because they're taking on that much more flow. They are building water plants, right, which is the water treatment facilities, because part of the Intel, part of the attraction to the area for Intel was the fact that Columbus had so much water, you know, deep water in their aquifers out there. So they're basically pumping the water out of the aquifers, running it through the Intel plant for cooling and for everything else in it, turning around, treating it, and putting it back in the aquifer. So from that perspective, Columbus, that's why it was, Wexner had enough ground, they had plenty of water, sewer, and the state had the incentive package to go along with it, and that's why it ended up there versus somewhere else in the country or somewhere else in the state.
So with Columbus doing the new, taking on a revision to the zoning code, do you see the suburban areas kind of following suit or and updating their codes, or?
No, I mean, no. I mean, I think some of them will, I think it's, some will, like the Whitehalls will, some of those areas that Reynoldsburg has, some of those areas will and have, but some of the areas that take southern Delaware County, right? The townships aren't going to change their zoning codes simply because the city of Columbus is changing their zoning code. You know, Dublin's not changing their zoning code, the city of Columbus is, right? So it's just going to be different. Municipalities are going to take a different approach, and you know, hopefully, I'm optimistic. You know, I'm cautiously optimistic. I haven't seen it over the last 24 years, but maybe they'll take Columbus's lead and update zoning codes to allow more density and more infill type developments versus continued sprawl. Right, and that's the real debate, right? Sprawl is easier for a politician to zone because there's not a lot of neighbors around sprawl, right? It's the next farm over, it's the next farm over. Well, if you do something, you know, in a more infill area inside 270, for instance, you have a lot more neighbors that are going to show up and participate in the process. And then you have politicians who have to answer to those neighbors at the ballot box. Therefore, you get different decisions. And so it's not changing the zoning code. Will be interesting to see exactly what comes out of it and what they change and what areas they attack first from that perspective. And you know, it's an overall code change is needed because again, most of the stuff you do, you get the density is fine, but you go through 10 different variances just simply to build on the plan because the code doesn't allow you to do what they've zoned you to do from that perspective.
And just a segue from there, where do you see the city of Columbus kind of going in terms of growth?
Well, I mean, it's probably 5 to maybe 7 years ago, they decided to really tamp down their desire to grow through annexation. So when they did that, they decided that they were going to go into I think it's the historical 1974 boundary, something of that nature. So really what that meant is where the city of Columbus was in 1974, they were going to not grow outside of that. They were going to then turn back into the core, and they had there was a reason to do it, and it's reasonable on its face as they continue to push their services for single family. It's not cost efficient at a $250,000 to $300,000 house from a tax base, and from the fact that the piece that the city gets from the real estate taxes is a small piece. I mean, we all know the schools get 75% of a dollar from a tax perspective, and the rest kind of chews up that 25%. Well, they looked at it and said service is just in a pay to continue to stretch out from that perspective. Multifamily is a different story. Multifamily pays for itself. Doesn't use as many services, not as many children go to the schools. You don't have it's a younger population. You don't have as many police runs, fire runs, things of that nature to stretch services. So multifamily, however, when they made that policy decision, they then said, okay, we're going to turn back in and densify the core because we have services there. We have a police station, a fire station. We have all the bus routes, everything they need inside the core existing. So why don't we do that? That makes a lot of sense. I don't disagree that it makes a lot of sense. However, at the end of the day, again, you have constituents that you have to deal with when you're doing, we're doing a project where it's large lot homes in a county, we're going to annex into the city. Well, there's homes all around it, and people don't want multifamily next to them necessarily, even though it's not a negative. They think it's a negative. It's not a negative. It's proven to not be a negative. However, that's just their mindset is it's a negative, and therefore it makes it more difficult to get through the entitlement process. It simply just takes longer, makes it more difficult. You have more, even more consternation amongst the groups, all those things. So, I think time will tell if the city and the city council and the mayor are going to, really push once they've done the zoning code, once they've got the public input, once they've set the code, then are they going to follow the code? When there's 100 people in city council that don't want it, however it fits the new code, are they going to push back against the people, or are they going to push back against the development? It's yet to be seen.
How do you see the overall housing situation in Central Ohio? Overbuilt, underbuilt, how over, under, what's your view? I guess it'd be mostly from the multifamily side, but.
Yeah, we're substantially underbuilt. We should be building, on a normal flow, we should be building between 12 and 14,000. We should be pulling 12 to 14,000 permits, single family, multifamily, up and down the spectrum. Right now, we'd need to be pulling 20, 21,000 to catch up to the 50 to 60,000 units that we're short. Again, all parts of this, all housing on all parts of the spectrum, right? Lower income, middle income, high income, just look at it all. We're short that many houses. So we're pulling, I bet this year they'll pull maybe 10. It's probably what'll happen. And I think with the current situation and the lending situation, I think next year will be even worse. Simply because if you're not a known quantity to a bank, if you don't have a track record with the bank, you don't have a product type that is desired in the marketplace, you have cross controls in place, deposits and a relationship with the bank, and you walk in and say, no, I have this great idea. I want to build multifamily housing. Right now, today, they're going to look at you and say, no, we have a certain amount that we're ready to loan, and we're giving it to the customers that have been our customers for years and have a proven track record. Otherwise, it's not, they're not funding projects. Makes it, today's underwriting is much more difficult, from an underwriting perspective. If interest rates go to, 8%, that's fine. But really where they're killing you is with the debt service coverage ratio. You know, they're taking, you know, where a 110, a 115, a 120, you know, fine, you can make that work. 130, 135, makes it very difficult to make a project work when you're talking about a, you know, a stress rate of 8%, 25-year AM, you know, all those things. It makes it extraordinarily difficult to underwrite projects. So I think you're going to see the effect of that is going to be less projects in the pipeline in 24 than should have been, and that's just the reality of it.
Can you talk a little bit more about the shortage on the housing and what's driving that?
Well, I mean, I think I think what's driving it. So if you look back, what really happened was 2006 through 2010, nobody built, right? There was no financing available. And when I say nobody, a very small percentage of the population was building any kind of housing, just simply because the financing was not available. Or the company was in such stress because they had been building to 2006, then the market dropped away. They're trying to just survive through 2006 through 2010. Then from 2010 to like 2014, people were just finding their way back into the marketplace. And so we had a gap from 2006 to 2014 where we were underbuilding, drastically underbuilding for the normal flow of population to come in. Right? We sucked up all the inventory that home builders had built, or had gone back to the market from 2002 to 2006. All that inventory got sucked up quickly because no one was building. Well, no one started building again really of any scale until 2012, 13, 14. And so when you have that much of a lag, in order to make that up, you've got to double up to catch up. And it's the entitlement process. Is that if you think about it this way, if you start a project, if I put a piece of ground and a piece of dirt in contract today, go out today, find a piece, put it in contract. I'm 13 months through the entitlement process, right? So 13 months from now, I will be ready to close my construction loan, right? So I spent 13 months entitling it. Then I spent from the time 13 months for another 24 months to get it stabilized and out, right? It's stable, constructed, stabilized, and ready to go to either sale or the permanent market. Well, if you think of that time frame, it's 3+, 4+ years, 3.5, 4 years to get a project today to out the door and ready to go 3, 4 years from now. And if you put that on pause for a year, it just moves it out another year. And so some of these economic conditions that we're seeing today are going to continue to put things on pause, and therefore it's just going to make the problem worse. Right? And it's, from a single family perspective or a multifamily perspective, it just builds upon itself where we're short. And I tell the mayor of Columbus all the time, if you give me the green light and say I can build as much as I can in the city of Columbus today, I'll give it to you 3 years from now. And that's green light as fast as you can go. So, if you don't get the green light today, it pushes another year out from there. And that's kind of why we got to where we are today, where we're so short. And then we have so much population coming in. What is it, 40 some odd people a day, something of that nature. It's a huge population coming in, and with Intel and everything else, it's not just Intel, it's everything that surrounds, it's the battery plants, it's all those things that are coming into the region. There's just not enough housing, therefore you have a shortage, you have a supply problem, we have a supply-demand issue. Simple economics 101, we have a supply-demand problem. Way too much demand, not even close to the supply.
Good, thank you.
You mentioned things are getting tightened up right now in underwriting standards, and they're looking to lend on.
So I can't speak.
Oh, sorry. You said banks are looking or tightened up right now, getting stricter underwriting standards. But you also mentioned that they're only looking to lend on certain products. What certain products are they looking to lend? And is that kind of aligned with what you guys do? I know one thing I've seen is like the mixed multi-use come up. Is that something you guys do?
Yeah, so we find You know, I used to tell people all the time, they'd say, what do you build? I'd say, well, I build a B plus A minus apartment, right? It's a B plus A minus, right? For years that made sense. So I was speaking at the Business First lunch or breakfast like 5-7 years ago, and someone said, oh, you do workforce housing. I said, well, thank you. Now I know what I do, right? I do workforce housing. I didn't know before, but thanks for telling me, and for these 800 people that I do workforce housing. It's great. Now I know. I appreciate that. But, you know, all kidding aside, what we build fits within mission-driven business for most banks and for Fannie and Freddie from a takeout loan perspective. So it fits in that mission-driven business. We're naturally affordable at 80 to 110% AMIs, where we that's a sweet spot where we go, right? So that is business that most of the banks want, the takeout lenders want, the cities want, especially Columbus, because that hits a large percentage of the population. So yeah, we build, you know, again, it's that, you know, that naturally occurring workforce housing, which is what's heavy demand in the marketplace. From a multifamily perspective, and again, with single family, we do the lot entitlement, and then the builders choose to do what they're gonna do. But from their perspective, naturally affording housing today is $350,000 to $450,000, which is generally not affordable for most first-time homeowners and people of that nature.
The majority,
Yeah, I think we're probably equal. I mean, I think as a company, we've built, and this gives you kind of a sense of kind of where we look at takeouts and whether we keep or sell. As a company, we've probably built 65, 70,000 multifamily units in the history of the company, which started in 1967. Don Kenney started the organization, and it's been going since 1960, so he's built that many. We own 5,000 total units. So from that perspective, we're more of a build-sell, you know, move it out, build another project. We self-fund all of our own equity, have no investors, no one else. So that kind of movement is required as you continue to do developments and do the scale that we do. So then when we do take them out, we prefer to go with some agency debt normally. Don't really do much don't do much FHA or HUD debt or anything of that nature. We'll do mostly Fannie and Freddie. Right now, mostly Fannie. And then we'll do insurance companies when they're in the marketplace. They're out of the market right now, so Fannie is your best takeout option. And again, since we're considered for Fannie and Freddie to be mission business at that naturally occurring affordable, we'll get a 25 basis point reduction in rate and spread rate simply because we fit within the mission that they're trying to provide financing for. So it makes it a nice marriage when you want to keep them and take them out with long-term debt.
have their terms changed at all in what's happened recently, as far as?
Yeah, I mean, it's like anything else. I mean, they're underwriting for what we do, it fits within that natural occurring business. So that underwriting is pretty consistent. What's changed, obviously, is rates, right? The 10 years through the roof, the spreads, so that's really what's changed. And, it's, if you're in that, again, if you're in that one tranche, you fit, therefore they're going to look at you first. Therefore, there's always dollars available, right? Sometimes they'll get tight at the end of the year and they'll close. So we're done. We've met our goal. But for the mission business, there's always dollars available through Fannie or Freddie.
All right, what advice would you give to someone just starting out who wants to do what you do?
Well, if you're not in real estate and you want to be a developer eventually someday, get in real estate, right? Find a way in, right? Whatever that way may be. I came in through really the real estate brokerage sales manager side, right? I graduated from college with a history degree and a photography minor, right? And was able to manage people at a young age, and then came to Columbus and took a job doing that. But what it did is it got me into real estate, therefore it got me more exposed to real estate. And so, when people ask me, well, and they say, well, I'd like to be you. I said, that's great. I said, I think it's great. There should be as many of me out there as possible serving the market, serving the industry, and developing projects. I said, but in order to be me, you work about 80 hours a week for the first 23 years of your life, 7 days a week, and you can be me, right? So that's easy. It's simple to do that, right? It's not a problem. You can be me. It's just more complicated because the nuances of the business If you're gonna go ground up development, there's so many different things that you have to know and master as you go, right? The entitlement process, you've gotta know. The relationship process of the city council, the mayor, or any of the trustees out there. You've just gotta know and develop these relationships, and it makes the process so much easier. You don't develop a relationship overnight. Trust is not built overnight. It requires time on task, proving, hey, I've told you I'm going to do this and doing that, and then continuing to do that for a long stretch of time. So I think, number one is get into real estate. Wherever you're going to get in, if you get in on the real estate sales side, if you get on the leasing side, if you get in the management side, if you get in the construction side, the financing side, just get in, learn that part of it, because you're going to need that part at some point in time to then have a well-rounded real estate development career, because otherwise you're going to miss something. And what we do, and what most real estate investors do, is take risk. And the question is how much, are you really taking risk if you know all the steps of the process? Yeah, you're taking some risk, but you're taking a risk that you've kind of looked at and judged and said, okay, I can accept that much risk because I know 9 times out of 10 the outcome is going to be this. Well, if you don't know 9 times out of 10 the outcome is going to be that, if it's 50-50, you might as well go to Vegas and put it on the roulette wheel, right? I mean, if you're taking a bet, right, taking a risk with no potential control of the outcome, it's not a good way to be, especially when the market gets tight. Like today, when the financing market gets tight, you have to know, hey, I can show up at this bank meeting, I can talk to them, and I can get what I need where someone else is not going to get that, because they know I'm going to be able to get all the way through the process with them. They're taking less risk, I'm taking less risk. So I think that's what I tell people all the time. Get in at any level that you can get in, and then from that, learn and grow, and move around. I start in financing. Great, it's a great place to start. If you can get in that way, start in financing. But financing doesn't teach you, how to zone a piece of property. Right? It can tell you how to put the numbers together, but doesn't tell you how you got to go down to the city and talk to the guy who runs the sanitary department and know what the different diameters of the sewer pipe is, because he's going to ask you go through that process. So I think that's just depends how you get in. But get in as early as possible and learn as much as you can, as many experiences you can have, and use those for the end goal, which is, if you want to be a real estate developer, that's the end goal, set your end goal.
Awesome. Any other questions from you guys? Yeah.
I'm not familiar with the residential side, but has the multifamily from the investment side mirrored, the appreciation rate? Is it lagging, advanced compared to what we have seen like in single family homes around Central Ohio?
Well, I mean, it's, we've seen good returns in the last, how could you say in the last 6 years? I mean, multifamily's been as hot as it could be. Occupancies are through the roof, from the pandemic forward, and even before that, it was really good. And then the pandemic, you had a bump. But from a multifamily perspective, the bump was not a lot of projects were being built. So if you could get through to build, you had something coming out the other side that was really sought after, right? People are chasing deals in Columbus, Ohio that I've never seen in my life. You're seeing people come in to Columbus and pay on a 4.5% cap, 4% cap rate, or 4.5 to 5. Used to be 6 to 7, right? Well, you start factoring that cap rate in, you're driving prices from, let's say 150 a door, right, to 220 a door. So it couldn't be the better time over the last 5 to 7 years. If you got in 7 years ago and you got out last year, you probably did. You almost couldn't have made a mistake. Now the problem is those people who got in and don't know, the full scope of what it is, are finding it impossible to get projects to pencil, because now where you used to go out and get, an investor, give them give them a 7% return, a pref return, and do all those equity thing. It's not available because you can go and get, get a CD or a treasury, and I make 5.5% with no risk. Well, there's something to be said for that, right? And if you're risk adverse, then you're going to accept that versus you're going to get it into real estate in a time when it's, it's not as easy to get in and get out. So I think in the last, 5 to 7 years, it's been as hot as it could be, right? It's always been good if you're a ground up developer, if you know how to do it, and you build from a cost perspective and the right, so I tell my friends who build buildings down here all the time, they tell me, I've got to get $3.50, $4 a square foot in rent. I'm like, well, I can survive on $1.25, and if I just want to pay my mortgage and taxes and make no profit, I'd probably go down to $1.10. So if I can survive at that, where am I positioned for a downturn? I'm positioned pretty well, where the guy at $4 or $3.50 a square foot, he's not going down to, $1.75. He's going out, right? And so, I think that's where it's more difficult now. And I think, you're seeing more of the historical developers continue to churn through the process, and some of the ones that were, new to the side, finishing their projects. It's probably staying on their construction loan longer than they want because they can't sell it, they can't take it to permanent debt financing. So it's, it's just a different part of the cycle right now. It's not right or wrong, good or bad, it just is, and you got to figure out a way through it.
As a developer, do you generally prefer to hold your developments, or do you sell them?
Yeah, I think it's, it's kind of as I indicated earlier, have been historically more of a seller. We're holding more now, and really just because it's a long-term decision to hold now versus selling, that we have looked at really in the past, and just for different business reasons and for different structural reasons with our organization, we're making that decision a little differently than we did before. So I'd still say, we're probably a 60-40 seller. So everything we build, probably 60% we're selling, 40% we're keeping. And it just depends on the asset, where it is, and what time, where we are in the cycle, how much we have going, capital needs, those kind of things kind of dictate where you go from there.
Gotcha. Any other questions from the audience?
If you were a bank, local bank, lending in the area, we've obviously got the housing shortage and everything, do you think it would be wise to lessen the guidelines, bend the rules a little bit and maybe take it down to a 1.1 or 105 and still make a loan because you feel like you believe in the housing market locally? Or is that setting yourself up for failure if you start trying to make things work?
Yeah, I mean, from my perspective, I see I guess it depends where they see risk, right? From my perspective, I see no risk in the construction. Some banks see a lot of risk in construction, some banks see risk in stabilization. It's where they see the risk, and no matter where they see the risk, it's really the regulators that are going to show them where the risk is.
Gotcha.
Right? Whether you like it or not, the regulators are going to tell them, if they come in and audit their bank and they've got 5 or 6 loans that they now decide are underperforming because of the new regulations, well, you put that bank out of business, right? And then it's a buyout target, right? Not because you made a loan that didn't work. It's just because you got out of balance. Right now, the problem's balance. I mean, if you want to talk, the biggest problem right now is deposits and balance in banking. Balance in the sense that any lending institution only wants a certain percent of every asset class, right? Right now, they're out of balance on commercial real estate. And the reason they're out of balance is because rates spike so hard that people, everybody who was buying sat on the sidelines for the last, I think it won't loosen up until probably March or April of next year. So we're talking about a year, in 5 months, somewhere in that range, where no one's transacted of any volume in the city, right? So everybody who thought my strategy was a sell strategy, right? It's not selling because no one's transacting necessarily, right? So you have a stagnant buyer pool because they're waiting to see what happens with rates, right? Because they don't want to get into a deal, do all the due diligence, spend the money, You know, you spend $400,000, $500,000, $600,000 to do your due diligence on a deal, spend all that money and then figure out rates popped again and it doesn't work. Right? So they're sitting on the sidelines. Consequently, the lenders are sitting on the sidelines. You know, they're sitting on the sidelines from the takeout perspective. Right? Fannie and Freddie's still available. Insurance companies sure aren't lending money. Banks aren't lending money for long-term, you know, debt refinancing for commercial real estate. So you're in a spot where it's sitting on the balance sheet of the bank when it had intended to blow off, you know, this year, let's say, or last year. Well, it's sitting there. Well, it's all continuing to sit there. So it's just stacking up, and their ratios are becoming out of balance simply because they're not getting the payoffs that they naturally would get on a normal market, right? Therefore, they're constrained on how much they can get out the door, right? That's a regulatory question. It's not that the banks don't want to. I just heard it tonight. We'd loan you all the money we can, but we're capped at 20 million, right? Your project's 30, we need 2 participants, okay? Right? 6 months ago, they would have done the $30 million project. No problem, no question. They do them all the time for us. But now it's 20, and that's just coming down. And he said to me, he said, you know, pay attention to an analyst call. None of them are going to ask you where your loan growth is. They don't care. They don't want to know. They want to know where your deposits are. They want to know where your assets that could be classified assets are sitting, or where the real estate book, what it looks like. They're not asking, well, why aren't you loaning more money out the door for commercial real estate? Well, if they're not getting pressure to do it from the analysts, which are pushing the stock, they're going to sit still because they don't have to. And that'll all change. As soon as interest rates stabilize, people will start doing transactions because they'll be, if it comes down and stays down for, you know, even a couple, you know, 50, 75, 100 basis points, people are going to say, okay, we've seen the worst. We now need to get in because we've got money to deploy. And that's kind of where we sit today. They've got money to deploy, just can't, you know, they don't feel comfortable getting out the door right now.
Yeah. But I think private equity funds that are doing, like they don't have the regulatory oversight that are filling the gap right now, or is that never?
Yeah, we haven't needed any of that. I mean, we're still finding, I mean, again, the reputation, our experience, what we're building, all of that fills most boxes from a lender perspective. So where it's more difficult for me to get financing than it was 6 months ago. And 6 months from now, it'll be easier. I'm still getting financed. It's just terms and conditions that I didn't have to accept 6 months ago. I was accepting today. I won't have to accept 6 months from now. You know, assuming, you know, we're not in a recession, assuming rates plateau, and, you know, if they dip down, you know, it'll be in a different position 6 months from now. It's just a moment of time where we're stuck. You know, and that's from both sides, really. I think the borrowers would rather sell the assets and move on, probably didn't plan on having it this long. And so, I mean, they'd like to get them sold or refinanced and move off their bank balance, because most of the time, if you think about it, banks are personal guarantees versus Fannie or Freddie loan is a, you know, a carve-out guarantee for bad boy items versus a personal guarantee. So sitting on your bank, probably still personally guaranteeing that debt in some form or fashion.
Any other questions? Yeah.
So is your view the Fed is turning their position in the next 6 months, I don't know?
Well, so here's the thing is if I had I told somebody again today, I said, if I had a view on that and I knew, I wouldn't be sitting here, right? I'd be on a really nice tropical island somewhere that I flew to back and forth on my private plane, right? I mean, I wouldn't be sitting here. I mean, I think you just have to take it for what it is, run your business the way you can, and deal with the blows as they come. You know, because I can't predict it. People always say, well, didn't you see the housing crisis? No, if I would have, I'd been the guy who wrote The Big Short, right? I would have known. No, I didn't. I just saw, you see what's in front of you, and that's what I learned through that process. You just have to put yourself in the right position for when you're, you know, when you have to make a pivot one way or the other, that you have the cash on hand to make that pivot if you need it, or you pivot to less projects, or you pivot to more projects. So I think you just have to take it where it is. And, you know, I look back historically, when I started in this business, rates were 8.5%. Deals got done. You know, I mean, did you make less profit? No, costs were different. Costs are a lot higher today than they were 26 years ago when I started. You know, but deals got done still, and rents are different. So, I mean, they're gonna get done. It's just, they're not going to be easy to get done, and they may or may not be as profitable at the end. But everybody defines what an acceptable level of profit is. Each company defines it in a different way. So you just have to figure out where your sweet spot is and then develop, you know, based on the parameters that you have in front of yourself.
Any other questions? All right, Trey, where can people find more about you?
About me?
Yes. Where can they connect with you?
Well, they just, I mean, from you have my bio, which is all I have. I don't do anything with regards to social media, so I don't have any of that. So the best way to get in touch with me is through my email address, which I think you have, or my assistant does. Probably the best way to get a hold of me if you want to get a hold of me, right? So I would say, you know, through your organization, I think you have my email address, and then that'd be the best way to get a hold of me is through email.
Awesome. If no other questions, we'll call it. Thank you, Trey, for your time. We appreciate it. Look forward to seeing you again.
Absolutely. I appreciate you having me and enjoyed the conversation.
Thank you.
All right, the rest of the time is for networking. Go converse, meet someone new, and help yourself with some food and some wine. And thanks you all for coming.